In this video, I am going to discuss about break-even analysis. Break-even analysis is also known as cost volume profit analysis, CVP analysis. Break-even analysis is a financial technique used to determine the level of sales a business needs to generate to cover its total costs so that it neither earns a profit nor incurs a loss. The term break even refers to the point at which a business is able to cover all its fixed and variable costs but is not making any profit. Simply, this is a financial analysis businesses do in order to find the break even point. The break even point is where the business is not making a profit and also not making a loss. Have a look at this chart. You already know some of the lines. The y-axis depicts the cost or the revenue. The x-axis depicts the quantity or the volume. You know the fixed cost line. This is the fixed cost line. Even though the volume is increasing or decreasing, the fixed cost is not changing. It is constant. And this is the line for variable cost. As you can see, as the volume is increasing, the variable cost is also increasing. As the volume decreasing, the variable cost is also decreasing. And then we discussed about the total cost line, which is this red line. It starts from the fixed cost amount and parallel to the variable cost line. And there is a new line, which is the green line, which represents the sales revenue. It starts from zero. As the volume is increasing, the sales revenue is also increasing. So, what is the break even point? As we discussed earlier, the break even point is the level of sales a business needs to generate to cover its total costs. So, this is the total cost line, which is the red line, and this is the sales revenue line, which is the green line. So, here, as you can see, these two lines are intercepting. So this is the break-even point where the total sales revenue is equal to the total cost, which means now the business can cover its total cost by the sales revenue. In other words, there will be no profit or no loss at this point. So the volume at which the break-even point occurs is known as the break-even volume. This is the number of sales unit the business has to sell in order to cover its total cost. The revenue business has to make in order to break even is known as the break even revenue. This is the revenue the business has to make in order to cover its total cost. So before this break even point, the company is making losses, which is this area. This is the area that the business is making losses. And after this break even point, business starts to make profit, which is this area, because the total sales revenue is higher than the total cost. These two characteristics are very important when it comes to break even analysis. At break even point, total sales revenue is equal to total cost. Let's go back. This is the break even point. Here, the total sales revenue and the total cost is equal to each other. You can clearly see these two lines are intercepting at the break even point. This means the sales revenue and the total cost is equal at break even point. At break even point, total contribution is equal to total fixed cost. You already know how to calculate the profit. Profit is equal to total contribution minus total fixed cost. So what happens at the break even point? At the break even point, there is no profit and there is no loss. This means this profit is equal to 0. So 0 is equal to total contribution minus total fixed cost. We can bring this fixed cost amount into this side. So total contribution is equal to total fixed cost. This is the characteristic of break-even point. You need to know about this equation when it comes to calculating the break-even point. This is the formula we can use to calculate the break-even volume. This is where we are calculating the volume at which the break-even point occurs. Break-even volume is equal to total fixed cost divided by the contribution per unit. This is very important. You need to take the contribution per unit, not the total contribution. After calculating the break-even volume, we can calculate the break-even revenue. Break-even revenue is equal to break-even volume multiplied by the selling price per unit. Let's go back to the chart. This is the break-even volume. Break-even volume is equal to total fixed cost divided by contribution per unit. After calculating the break-even volume, we can calculate the break-even revenue. Break-even revenue is equal to break-even volume multiplied by selling price per unit. Depending on the requirement, you need to calculate either break-even volume or break-even revenue. You have to have a thorough understanding about this chart when it comes to break-even analysis. In the OTQ exam, you are not required to draw any charts, but you have to have understanding of how to read the charts and extract data from the chart so that you can calculate the break-even point. You know this equation already. Profit is equal to total contribution minus total fixed cost. Contribution per unit can be calculated by selling price per unit minus variable cost per unit. You need to know about these two equations when it comes to break-even analysis. Now let's do this example. Company A manufactures product X. Variable cost per unit is $6 and the selling price is $10. Fixed cost per year is $1,500. Calculate the break-even volume and break-even revenue. In order to earn 500 profit per year, how many units have to be sold? So let's do the first requirement. Break-even volume. Break-even volume is equal to total fixed cost divided by contribution per unit. Total fixed cost is equal to 1500 divided by contribution per unit is equal to selling price. Selling price is $10 minus variable cost. Variable cost is $6. So this is equal to 1500 divided by 4. So the break-even volume is equal to 375 units because this is a volume. Now let's do the second requirement. Calculate the break-even revenue. Break-even revenue is equal to break-even volume multiplied by selling price per unit. So this is equal to 375 multiplied by $10. So $3,750. This is the break-even revenue. Simply this means the company has to sell 375 units in order to break even or in order to cover its total costs. The business has to earn $3,750 in order to cover its total costs. After this revenue, business starts to make profits. Now let's do the third requirement. In order to earn 500 profit per year, how many units have to be sold? We know the formula to calculate profit. Profit is equal to total contribution minus total fixed cost. They have given the profit. Profit is $500 is equal to total contribution minus total fixed cost. Fixed cost is 1500. Total contribution is equal to 500 plus 1500. So total contribution is equal to $2000. Now we know the total contribution and we know the contribution per unit, which is 10 minus 6, $4. Using these two values, we can calculate the number of units the business has to sell in order to make a $500 profit. So number of units is equal to 2000 divided by 4, which is 500 units. This means if the business can sell 500 units, they can make $500 profit. As you can see, this amount is higher than the break-even volume. Now let's discuss about the margin of safety. Margin of safety measures the level of sales or revenue that exceeds the break-even point of a business. In other words, it represents the amount by which a company's sales can decline before it starts to incur losses. This definition is very important. Margin of safety can be calculated in the form of volume or revenue. Margin of safety is a percentage value. Now you know this chart. This is the break-even chart. This is the break-even point where the sales revenue is equal to total cost. This is the break-even volume and this is the break-even revenue. So what is the margin of safety? Margin of safety is the volume or the revenue that exceeds the break-even point. So this is the margin of safety in the form of volume and this is the margin of safety in the form of revenue. We can calculate either margin of safety using the volume or using the revenue. These are the formulas to calculate the margin of safety. Using this formula, we can calculate the margin of safety in the form of volume. Budgeted volume minus break-even volume divided by budgeted volume. Then multiplied by 100%, we can calculate the margin of safety for volume. Using this formula, we can calculate the margin of safety for revenue. Budgeted revenue minus break-even revenue divided by budgeted revenue then multiplied by 100%. These two formulas are the same. The only difference is the first formula is using the volume and the second formula is using the revenue. Depending on the requirement in the exam, you have to use the correct formula. Now let's do this example. Company A manufactures product X. Variable cost per unit is $6 and the selling price is $10. Fixed cost per year is $1,500. Calculate the break-even volume and break-even revenue. If the company has budgeted to sell 420 units in the next year, what is the margin of safety in volume and in revenue? This is the example question we did earlier. So we calculated the break-even volume, which is 375 units. Then we calculated the break-even revenue, which is $3,750. Now we have to calculate the margin of safety in the form of volume. Budgeted volume minus break-even volume, budgeted volume. So the budgeted volume is 420 minus break-even volume is 375 divided by budgeted volume 420 multiplied by 100%, which is equal to 10.7%. This means the budgeted sales units can be declined by 10.7%. before it starts to make a loss. Now let's calculate the margin of safety using the revenue. So this is equal to budgeted revenue minus break-even revenue divided by budgeted revenue. Budgeted revenue is equal to 420 multiplied by 10 minus 3750 divided by 420 multiplied by 10. This multiplied by 100%. As you can see, this is also equal to 10.7%, which has to be. You have to understand what is this 10.7% is. This is the percentage of budgeted sales or the budgeted revenue can be declined before the business starts to make losses, which means they have a margin of safety of 10.7%. Let's say the budgeted sales declined by 8%. Are they safe or not? They are safe because another 2.7% can be declined before the company starts to make losses. Let's say the budgeted sales units has declined by 11%. Are they safe or not? No, they are not. This is because now the sales units are below the break even point, which means now the company is making losses. Now let's discuss about contribution to sales ratio. This is also known as the CS ratio. Contribution to sales ratio, or this is also known as contribution margin ratio or profit to volume ratio, measures the percentage of sales revenue that is available to cover fixed cost and contribute to profit after variable costs have been deducted. In other words, the contribution to sales ratio represents the portion of each sales dollar that is available to cover fixed costs and contribute to profit. A higher contribution to sales ratio means that a greater percentage of each sales dollar is available to cover fixed costs and contribute to profit, which is generally considered a positive sign for a business. CS ratio for single product is constant. This is very important. The CS ratio for a single product manufacturing company is constant. This is the formula to calculate the contribution to sales ratio. Contribution divided by the sales revenue. CS ratio can be calculated using per unit values or total values. Depending on the requirement, either can be selected. This means here we can use the contribution per unit value or the total contribution. Depending on the requirement and the given data, you can change for per unit values or for total values. We already know this formula. Total contribution is equal to selling price minus variable costs multiplied by sales unit. This is the contribution per unit value. Total contribution can be also calculated by profit plus total fixed cost, which is this equation. Profit is equal to total contribution minus total fixed cost. These two formulas will be helpful when calculating the contribution to sales ratio. Now let's do this example. This is the same example as before. Company A manufactures product X. Variable cost per unit is $6 and the selling price is $10. Fixed cost per year is $1,500. If the company has budgeted to sell 420 units in the next year, what is the CS ratio? What is the sales revenue should the company earn in order to make $500 target profit? So now we know the break even volume is 375 units. Break even revenue is equal to $3,750. Now what we have to calculate is we have to calculate the CS ratio. CS ratio is equal to contribution divided by the sales revenue. So the contribution per unit can be calculated here. Contribution per unit is 10 minus 6 divided by sales revenue. Since we use the contribution per unit value here, we have to use the selling price per unit value for the denominator, which is 10. So this is equal to 4 over 10. Let's say the question has not given the data for per unit values. Instead of, the question has given the values for total values. Let's say they have given the total contribution. Now what we have to do is we have to calculate the CS ratio using the total value. So this is equal to total contribution divided by the sales revenue. This will also give the 4 over 10 value. Remember that CS ratio for single product manufacturing company is constant. Now let's go to the next requirement. What is the sales revenue should the company earn in order to make 500 target profit? Now we know the CS ratio is constant. So the CS ratio for this company is 4 over 10, which is equal to contribution over sales revenue. So they are asking the sales revenue, and we can calculate the contribution. Total contribution is equal to profit plus total fixed cost. The profit is given as $500. The total fixed cost is 1500. So 2000 over sales revenue. So the sales revenue is equal to 2000 multiplied by 10 divided by 4, which is equal to 5000. So this is the sales revenue the company has to make in order to make a 500 target profit. Now that we know the CS ratio, we can calculate the break-even revenue directly. If you can remember earlier, we calculated the break-even revenue using the break-even volume. Break-even volume multiplied by the selling price per unit. Now we do not have to use this formula. We can use the CS ratio directly to calculate the break-even revenue. So the break-even revenue is equal to total fixed costs divided by the CS ratio. Let's do this example. Company A manufactures product X. Variable cost per unit is $6 and the selling price is $10. Fixed cost per year is $1,500. Calculate the break-even revenue. So the break-even revenue is equal to total fixed costs divided by the CS ratio. Total fixed cost is 1500. The CS ratio is contribution. Contribution is 10 minus 6 divided by the selling price per unit, which is 10. This is equal to 1500 divided by 4 over 10. This is equal to $3,750. This is the revenue we calculated using the break-even volume. Under break-even analysis, the break-even chart and the profit volume chart is very important. You have to have a broad understanding about this break-even chart and the profit volume chart. In the OTQ exam, the knowledge about these charts will be tested. You are not required to draw any charts. You have to have an understanding of what are these axes and what are these each line represents. And using the charts, you may have to calculate the break-even volume, break-even revenue, margin of safety and contribution to sales ratio. So have a good understanding about these charts. Now let's discuss about the profit volume chart. The y-axis depicts the profit. The x-axis depicts the volume or the quantity. As you can see, this line intercepts the x line here, which is the break-even volume because the x-axis is the volume line. So this represents the break-even volume. This line starts at the fixed cost amount. If we consider the earlier example, Fixed cost was 1500. So minus 1500 because this is below the zero as you can see. As the volume increases, the line is also reaching to the break-even volume. So the area below the x-axis is negative, which means the company is making losses. After the break-even point, where the area above the x-axis is positive, which means now the company is making profits. You have to have a good understanding about this profit volume chart as well. When there is no profit, no loss, the break-even point can be identified, which is here. If we consider the earlier example, this will be 375 units. Now let's discuss about the limitations of break-even analysis. Assumes costs and the prices are constant. This is a limitation of the break-even analysis because under break-even analysis we assume that the costs of the products and the prices of the products are constant. In the real life, this is not true because the costs and the prices may change as the time goes by because of the competition and other external factors. Assumes linear relationships. Break-even analysis assumes that the relationship between costs, revenue and the volume is linear, meaning that costs and revenue increase or decrease at a constant rate. However, in reality, this relationship may be more complex with fixed and variable costs, economies of scale and other factors that impact the relationship. Ignores external factors. Break-even analysis is focused solely on the internal costs and the revenue of a business and does not take into account external factors that may impact sales volume, such as changes in the market, competition, or economic conditions. Assumes a single product or service. Break-even analysis assumes that the business is selling only one product or service. However, many businesses have multiple products or services with varying profit margins, which can complicate the break-even analysis. Ignores time value of money. Break-even analysis does not take into account the time value of money, meaning that it does not factor in the impact of inflation or the opportunity cost of investing funds elsewhere. Limited to short-term analysis. Break-even analysis is generally used for short-term analysis as it assumes that costs and revenue will remain constant over time. However, over the long term, businesses may need to adjust their pricing, production, or marketing strategies in response to changes in the market or competitive landscape. Thank you for watching. See you in the next video.